Greetings. This is Pro Readiness Traders. We're in Chapter 5. Title of this chapter is Reversals versus Indicators. Earlier today, we covered a lot of information uh, dealing with reversals in Chapter 4. We talked about candles in Chapter 1, and we talked about um, within the chart itself, there's also reversals, such as if we look right here, we talked about this could be a possible double bottom because we see it comes up here, but then what we see is two bottoms right here lining up, right? So we talked about various different patterns within the candlesticks themselves that would be good indicators to be able to profit off of. We talked about the consolidation of things shaping like a flag, and we can see that right there. We talked about the trend lines, and we were actually tying in a lot of the what is called indicators within this market. Now, I'm going to, we were also in, if you look up here, I notice I'm in the British pound versus British US dollar. Um, Originally, we was in the SPX, which stand for the S&P 500. That's what I basically taught the entire class on one market. Well, I just deliberately switched over to the British pound. In chapter 4, we set up a lot of indicators and we talked about moving averages. We talked about RSI, relative strength index. We talked about the stochastic. We talked about the MACD, MCAD, which stands for moving average conversion diversion. We talked about all these indicators and connecting them to where they can show possible reversal signals. So it's not about really, even though I titled this what is called reversals versus indicators, there is no indicators without reversals, and there's no reversals without indicators. So they're almost intertwined together. So that's just something I just wanted you all to be aware of. Okay. Um, Also, I wanted you to come here because I deliberately changed your charts to the British US dollar because I wanted to show you how your strategy, as long as it's set up right, it works on any market. Read my lips. Any market. Okay? So I went in and put in the code by looking up here. I can see this says GBPUSD. That's our symbol. Remember, in order to get to our symbol, we just click right here. See that? And we don't need to click there and do anything to that because we're already there. So I've already clicked over on this side. And also remember what we said. We wasn't going to put all of our indicators on one particular pattern. And as we knew that we got these lines right here from the swing, retrace, and retest, which gave us an idea of possible reversal, support and resistance. Okay, and we know we was going to keep the volume, which is down here, to show the amount of people that's making exchange within this market. We were going to keep that as well. Okay, but we didn't want to clog and clutter up our screen, right? And I'm going to talk about a little bit this in a minute. But we didn't want to clog up our screen, so what did we do? We decided to put our indicators on another one. And we talked about the amount of markets that can get on one particular screen once you subscribe. You can start off with $29 and get at least four markets on one window. And you can open up multiple windows, then that would give you eight. You can actually open up four of these windows on one screen, one big screen, and then put four markets in each one of them, get 12 markets, however you want to do it. Or you can go ahead and buy the whole 8 part package. That way you get two windows on one market or one window on one screen and have really a nice, good window to be able to look at a wide range of your candles chart. this, which is this part right here. So we go right here to the ticker symbol, right? And we're going to put this symbol search so we can pull up the British US dollar. Now this symbol right here, this is called Oanda, and I have just opened up this account. Um, this is a practice account. This is my practice account that we're in. And what I decided to do is that I opened it up. Now, what I normally do when I look for various different Forex markets, I like to keep them connected with the app, the platform, whether you're using TradeStation, whether you're using Robinhood. Well, believe it or not, various different company brokers are connected to TradingView, and you can actually connect TradingView to Oanda, and this way you wouldn't have to open up the app from here. You could actually come here and make your buy and sell. But what did I tell you in chapter maybe one, two, three, four? Maybe I said it in five. I said that I don't do that because I don't like to connect my charts with when I make actual order entries, when I'm actually placing a trade and expecting that money to go to my bank. I like to keep them separate. So this way the broker doesn't have access to looking at my chart. Whether he does, whether he don't, I don't know. I don't take a chance. So we'll come over here, right? And we're going to put in GBP. And you probably already see it pop up, USD. There we go. So when we scroll down here, we see GDP USD, and we see it's Oranda and it's Forex. So that's the one we're going to use, which is going to be the same market that is actually in Forex. Let's see. Um, as of today, today is Sunday. So, we know the market is actually not open, but we can put in an order. It is possible. See, it says weekends and closed markets, hiding enabled, no data. Um, okay, so we'll open this up and get these markets going in our next lesson. But right now, I just wanted to show you, and then in the next lesson, we'll see how the chart is going to be the same as this. And that's good because I've been in situations where I've been trading and I open up another broker and use their brokerage, and then I'm on my own charts and I'm using a different company, and sometimes the candles are not the same because it's a different brokerage company. So that's important to know. And remember, we're dealing with the micro, e-mini. That's why we're being able to trade low amounts of money. So, and then brokers wants to get people with low amounts of money so they can try to take your money. So that's why they're allowing you to trade in markets that, normally would cost a lot amount, especially futures. To hold one S&P, remember it costs almost $12,000. And in our last chapter, I will go into showing you exactly what that looks like in terms of being able to know you know, the amount that is going to be charged, commission fees, and the amount is going to be charged when you're in the market overnight and how that works. We'll do all that later. Just work with me, okay? Okay, so we have our indicators, right? And now we have what is called our chart, right? We know that we can take the chart itself and search for patterns in the market. We talked about that, right? And we look for setups at our lowest low, right? We're looking for it at our lowest low. So let's just go back to where we first remember in chapter 4 we set up these Fibonacci numbers and we was using the rule of the lowest low. Remember, we started from here, which is the lowest low, and we came all the way up here to create the Fibonacci numbers to put, and we were only using, I believe it was the 236, the 382, the 5, and the 681. We wasn't using this one. Now I will say this for the record, and this is something that I need to mention to you. This is also something I did, and I'm going to try to take it off auto. is that when I did this Fibonacci originally, right, I did not put it the right way. So I reversed the Fibonacci to show you the extensions. See that? These are called extensions. So even though we're only focused right here, you know, if it was a situation where the market did go up, and you can see it starting to go up right here, and if you look right there, that's still part of this extension. That extension could possibly be still in effect, right? And so, and we look at this extension and we see it, just staying with this grid, it actually lines up with this one. How about that? Look at that. See that? So this is another possible, remember, and the market hasn't even came up here yet. Actually, the market is starting to go back down. See? But had it continued to go, and without having no information, this could have been a possible reversal right here as well. Okay? So let's just go back to the beginning where we talked about how we did the highest highs and the lower lows, right? And then we talked about predicting pullbacks, right? So predicting pullbacks, and it's beautiful now that we're looking at this chart. We're looking at our chart now. We're looking at the Fibonacci setups. We're looking at our lines, our horizontal ray lines for possible support and resistance and reversal signals, right? Now we talked about pullback, right? And we talked about the swing. Sing it with me. Remember that song we had? Swing, retrace, retest, right? Here's a retrace, here's a retest, here's a retrace, and here's a swing up, retest, right? So these retraces, you can consider them pullbacks, huh? Look at that, now you're with me, you follow me? Here's the swing. We predicted the market is going to go up, right? Now we may think, okay, well, the market, is it turning? And if it is going to turn, we may feel like it would have continued right here, but however, the market broke right here. See that green where it went up and then it came, now it broke. At this point, we could have gotten in the market right here, right? But we also have to be careful right here. So since I would have seen a possible support and resistance right here, and when it broke this, I could have did one or two things. I I know that this market is going to swing down or it's going to swing up, right? And if I could have, because it went right here, it closed right here extremely down, it went up, I could have gotten in the market for a potential reversal right here. This would have been the reversal, even though it popped up right here and it did reverse and came back down here. But it never pierced here, right? It pierced right here. So there was a sign that it could have been going down. And I would have said use this line to be my exit, right? And of course it started popping back up, and I would have probably used this line right here to become my next exit, just in case it went down, right? But in this case, it pierced it at this point right here. Let me see if I can open that up a little bit more, and you can see a little bit better. Yeah, you can just see where it pierced it, right? Let's see right here. So now I could have said, okay, I'm gonna get out right here on my support resistance, but I'm gonna take profit at my support. And look at that. Look what just happened, y'all. Isn't it kind of weird how they're respecting your swing, retrace, Fibonacci? Look at that. And if it would have went past this, I would have gotten out. But here it just completely lowered. Looked like it tried to take back off, but then it continued to break it right here. So this would have been my next possible, where I would have had a stop loss. However, it didn't touch there. It's continued to swing back up. And this would have continued to be until it's broken, right? And then here you can see where it's broken. But however, in advance, this is what I want to say. In advance, you would have known whether or not this was a continuing market. And that's something that you have to get to in the next class. And that's something that we're going to work on.